Hi, my name is Jim and I was retired. In this week's video, I'm going to explore the question, will the Fed put a cap on inflation? Now, it really all comes down to an FOMC meeting in December and the rate and pace that they choose. Then, what will their summary of economic projections look like at that December meeting? Will they have a path for the Fed funds rate to put a cap on inflation? Now, this is really important for those of us on fixed incomes like retirees, because inflation really crushes us. And so the faster that the Fed can put a cap on inflation, the better off we'll all be. But if they take a gradual 50 basis point hike and then continue with quarter points and pauses, they're going to fall behind inflation again. So these next few months will really decide whether we put this behind us or relive the 1970s. So for this week's video, I'm going to explore some of the things I've been following this week to see what path we're on. Follow me. I'm going to begin here on my Twitter feed. And if you haven't subscribed to Twitter, I'm still using it. I'm not going anywhere. I am not signing up for a blue check, $8 a month or anything. But I am going to continue to use Twitter to talk about my YouTube channel. So follow me if you'd like to see more up-to-date information as I receive it on my Twitter feed. Otherwise, just hit the like and subscribe on the video YouTube below and sign up for this channel. This latest story here is just from today. It's from Steve Matthews at Bloomberg, and it talks about their survey of economists on Wall Street and what they expect the Fed to do. Their survey of Wall Street economists is split on whether the Fed is going to cut rates later in 2023. There's one school of thought that says they're going to raise it to a terminal rate and leave it there until they're sure that inflation is back down to the 2% target. And others think that they're going to have to address a recession next year and cut rates towards the second half of 2023. So if you see in this chart here in the Bloomberg article, they believe it's going to be a 50 basis point hike in December. The 4.4 is the effective Fed funds rate, which is within the range. So a range that takes it up to the 425 to 4.5 will have an effective trading of 4.4, and that's how this chart works. And they're going to say that the terminal rate is about effective rate of 4.9. Well, that means a real target upper range of about 5. Now, this chart lower in the article shows some of those Wall Street economists, their house, where they come from, and what they believe the peak will be and where the Fed funds rate will be at the end of 2023. And it ranges from Nomura Holdings believing that the peak will be at 5.75 all the way down to Morgan Stanley believing the peak will be at 4.75. The end of 23 column really shows whether they believe there's going to be rate cuts later in the year in 2023. Now, another poll was Reuters. Reuters came out with its survey of economists on Wall Street, and they believe that the Fed is going to lift rates by 50 basis points in December, but then the peak policy rate will be higher. And so that's their survey results. An additional question that the bigger risk was that the rates would peak higher and later than they expect now, with another 4 saying higher and earlier. So most of them believe that the bigger risk, is that the peak terminal rate will happen higher and later than they're expecting. and only 4 of them say that it's going to be higher and earlier than they're expecting. So those people believe that the bigger risk is a slow, drawn-out increase to a higher terminal rate next year. Only a small number of them, 4 of them, believe that the risk is to continue front-loading the rates. This summarizes it. The bigger risk to the Fed funds terminal rate forecasts, 57% believe that it's going to be later and higher than they expect. 29% it's going to be earlier and lower than they expect. And 14% believe that it's earlier and higher than they expected. The other graphic that this article had was this poll on where they think the rates are going to be. And the bottom chart here is the one I want to pay attention to. This is where we are with CPI, and then the dotted line is their median of the poll results of where they believe that CPI will go through in 2023 and 24. And the blue dotted line is where they believe the federal funds effective rate will be in its median range through those periods. And you can see, they don't believe it's until the second quarter that the Fed funds rate will get above CPI. Now, keep in mind, the Fed actually uses PCE as its target, Personal Consumption Expenditures, and not the CPI or Consumer Price Index. So what do I use? I don't survey economists to figure out where I think inflation is heading. I use the tools that I find on the internet, and one of them is the Cleveland Fed's nowcast for inflation. And they do nowcasts for both CPI and PCE readings. And paying attention to the bottom chart here, down here, the year-over-year percent change, in 2 weeks, we'll know how accurate this is. We're going to have the latest PCE, Personal Consumption Expenditures reading, year over year, and they're predicting 6.03 in October. At the end of November, we'll get that reading. And at the end of December, we'll get a reading of about 5.86. So a very modest decline in PCE for the next 2 months, according to the nowcast readings. What do we think is going to happen with the Fed funds? I pay attention to the CME FedWatch tool, and I've shown this page before. This is the probabilities page of the Fed funds futures. These are people who are actually investing their money on options on where the rate is going to be. And so this has got some science behind it of the wisdom of a crowd coming up with an estimate. They predict a 50 basis point increase in December, and then another 50 basis point increase at the February 1st meeting, which is sort of like their January meeting. It'll be their first meeting of the new year. And then when they meet in March, they'll leave it there. And then they will increase to 25 basis points up to the terminal rate of 5.25, and leave it there for several meetings, and then cut a quarter point, pause, and cut another quarter point. This is where the FedWatch is currently predicting the Fed funds will be. The question is 5.25 going to be high enough to put a cap on inflation? I've shown this on my Twitter feed and in an earlier video as well, but let me go over it one more time with the latest numbers crunched in here. The CPI last reading was 7.7. The current reading is PCE is at 6.2, and in 2 weeks we'll have the latest numbers. I expect it to be somewhere along this dotted line here. Now, if it tracks that direction, which is the same direction as this red line, the core CPI, and that's CPI without food and energy, then we're likely to be around 4.9% by March of next year. And if we stayed on 75 basis point increases, we'd be comfortably above that at 6.25% by that March meeting. But if we fall back down to 50 basis points and stay at that pace, we'll be a half a point above, around 5.5 by that March meeting. But if we pause or drift down to quarter point increases, we're not going to hit that number. If we stayed at a quarter point all the way, we'd be at 4.75 with inflation at 4.9. And that means we'd be chasing inflation, not putting a cap on it. So rather than talk to Wall Street economists, you could also ask consumers where they believe inflation will be. And we had two numbers recently, one from the University of Michigan survey, and they believe inflation a year from now will be at 5.1%. And then the New York Fed, in their survey of consumer expectations, they believe that inflation will be at 5.9%. And those are important because if they believe a year from now inflation is going to be at that level, will we have a Fed funds rate that's above it and can put a cap on it to bring it back down to where it should be? So the Philadelphia Fed also released their survey of professional forecasters. Their forecasters are not just the Wall Street crowd, but a broader look at professional forecasters. And this is one of the oldest surveys of professional forecasters in the U.S. Their latest reading, the red line, shows where their forecasters believe inflation will be a year from now from their latest numbers. They believe inflation will be at 3.5% by the end of the year. And again, I show the year ahead number to track with what I track with the consumers. Let me just conclude with my standard warning. I am not an economist. I'm not a financial planner. I'm just an average retiree. So please take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.